All right. We should be live and we are live. Happy Thursday, Kyle. What's up, man?
Happy Thursday. How's it going? I
Good.
can't believe it's Thursday.
I kind of miss August, don't you?
Yeah,
No, no.
minus the heat,
Yeah.
but
Uh
I love fall.
yeah,
So,
nah, it's all good, dude. Yeah, it's full speed here. Market's heating up. We've been working our buns off, as I'm sure you have as well. We're slow summer months done. Markets were quiet. Now we're heated right back up. So all kinds of stuff in the news. We did a portfolio rebalance, reallocation. Kyle's working incredibly hard on client service, financial plans, moving money, all kinds of things. So all good. I did CNBC this morning. I was on at 5:30. Had a good hit. We'll talk about that. What else? What else, man? What on the opening comments? What else do we need to talk about?
yeah, just, you know, got the rate cut. That's something we were kind of covering a lot leading up to. Got some updated job numbers, I guess, today, which kind of played into the kind of cooling off or shaking out that we've seen in the market this
Yep.
week. So, just kind of new week, more information, more economic news, and definitely talking with clients a lot right now about allocation and making sure that their assets are placed where they need to be, based on what their needs are, what their preferences are. So I think that'll kind of continue to be a theme as markets reach new all-time highs and have started to actually cool off a little bit now, which, definitely a good time to look at reallocating if you are kind of heavy in stocks or if you're looking to work in, looking for a good entry point there. So having a lot of those conversations with people right now.
So let me ask you: those conversations, are they spurring? Is there a result of, as you said, markets at all-time highs? Q4, this pocket of volatility, again, end of year planning, is it all of the above, or is it one that stands out in your mind more than the other?
Um, to me and most of our clients we have worked with quite a while and know exactly what their needs are. So I'd say most of it is not necessarily deciding to make changes, but reevaluating, consolidating, like whether they want to put more into stocks at this point because they have
You
at this point because they've seen some gains in their accounts, or have they seen some gains in their account and they're thinking, I'm in my early 70s or late 70s or whatever it is now a good time to kind of take some volatility off and smooth out my returns, kind of
so
protect my
it
gains,
seems like
smooth
the
out my
answer is,
returns going
hold on, it
forward.
seems like the answer is because we're at all-time highs. Is that the
Yeah,
answer? Okay,
yeah, I
good.
think so.
Got it.
A
Okay.
lot of for better or worse, that's kind of the point when a lot of people take a hard look at their stock allocation is when we do get news that we have reached all-time highs.
Good to know. Good to know. Okay. Interesting. All right. Yeah, we're gonna have more and more conversations about that. I think all the above, end of year, markets at highs, continued uncertainty, governments investing in in private companies. We've got a lagging labor market. It's busy, and I was joking when I said, "Boy, I miss August." It was kind of boring. Markets are quiet. Uh, Now it's 55, 60, rainy. I have a cold. Markets are busy. We're working hard. This is the way it should be. This is where we earn our money, Kyle. So let's go to work.
Hmm. Yeah, exactly. Now that the lake weather's moved on for the year.
Yeah, yeah. Now that the track in Saratoga is closed. Okay, we're gonna push through that. We usually start with something fun. So at least on the internet, actually, they're both New York events. The Ryder Cup starts this weekend, which will be super fun at Bethpage. Kyle, someday we have to play that course. It's insane. It's crazy.
Yeah,
And
I'll humble myself in
it's
advance.
dude, the
Close to
one
the
time we played, like we had to sleep in the parking lot to go play. Like it was brutal. Like you have to literally,
man,
there's like this whole, because it's a municipal, you have to get your ticket and wait
like
in line, and
first come.
it,
Yeah,
oh, it's
jeez.
crazy. And the other good news is the Yankees are now in tied for first in the AL East with the Blue Sox. This is the first time, and most people don't care. It's the first time the Yankees fan are really rooting for Boston, because if Boston continues to beat Toronto tonight, the Yankees will be in first place, and that will set us up for the ALDS Division Series and bypass the wild card. So, all kinds of fun stuff
Mm.
happening. All right, so what are we doing here today? There's, as I said, there's a lot of data, there's a lot of news, a lot of stuff happening. There's market volatility. We're gonna hit you with the key events that happened so far this week. As Kyle said, I can't believe it's already Thursday. This was just crazy. Like Nvidia is like, oh, we're gonna invest $100 billion into OpenAI. Sam Altman, which is ChatGPT, which is like a way of life for me now. I know Kyle's a Grok guy. I've just kind of settled on ChatGPT. It's game changing. Got my parents into it. Like it's insane. So the deal, this is right from CNBC. The deal between NVIDIA and OpenAI, large scale AI lab plans to build and deploy NVIDIA systems require 10 gigawatts of power, which I kind of thought. Remember Back to the Future when Marty shows up to Doc Brown, he's like 1.21 gigawatts. Great Scott. And Marty goes, "What the hell's a gigawatt?" Come on.
They were in megawatt back then.
Yeah, I mean, I still don't know if the gigawatt from Back to the Future, which he's saying is the bolt, is equivalent to a bolt of lightning, is the same as today's gigawatt. I don't know. If somebody knows, let me know. But requires 10 gigawatts of power, which is equivalent to 4 million and 5 million GPU units, according to Jensen Wang. So it's unbelievable what's happening, and I just want you to pay attention. I'm not just regurgitating the news. The few things I'm going to talk about with these deals that are happening, particularly around the AI build out, the rotation we're seeing within this market that I think is partially causing this slight bit of volatility that we're going to talk about. It's more in the hardware, it's more in the picks and shovels, it's different areas of the market that, and I'll to those astute market observers who may be able to see a bit of a rotation out of growth into value in defense because the market is down a little bit in the last few days. I think there's more, it's a more nuanced point that I'm going to try to make to you today. Kyle and I are working at half speed. I got like 4 hours of sleep last night, up prepping for CNBC, then up at 4. Kyle's beautiful new baby girl, as was kept you up most of the night. So we're gonna try to make sense of it today, but I think we can do it, right, bro?
Yeah, let's give it a shot.
All right. So the other thing that happened related to the cause of the volatility, but I think Powell had his Greenspan moment this week, and I'll explain what happened. Now, this was all on Tuesday, Kyle. The OpenAI $100 billion investment as a recipient from NVIDIA was the same day that Powell, in a speech in Rhode Island, was asked how much emphasis he and his colleagues place on market prices and whether they have a higher tolerance for higher values. We do look at overall financial conditions, ask ourselves whether policies are affecting financial conditions, blah, blah, blah. But you're right. By my measures, for example, equity prices are fairly highly valued. And then I thought about, I don't know, I don't know why I'm all about the movie quotes, but there's a scene from The Naked Gun when Drebin does something extremely stupid and everyone in the audience just does one of these, like the face
Well, good old
palm,
face palm.
the
Yeah.
face palm. So this is a half hour chart of the NASDAQ when Powell was speaking, and this is the result. Okay, so this is like since Tuesday. So this morning, I'm like, all right, I'm watching after we rebalance the portfolios. We got a bit more aggressive in TAG, backed off a bit in SIG, which we will talk about. The market is, we opened down here. This is what this candle means. We opened down here at about 588 or so in the Qs, and we've moved back up. Will we close the gap? We'll see. But clearly, Powell put a shake in this market. Okay. And people were saying, one guy who I really, really respect, Ed Yardeni, I love reading his material. If you're into fundamentals and economics, it's like $30 a month. I highly recommend you subscribe to it. He's like, this is his Greenspan moment. Now, for context, you're a young buck. You don't remember this, but you're a smart young buck, so you certainly have studied it, Kyle. In 96, Greenspan gave his famous irrational exuberance speech. So the challenge of central bank, blah, 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 while accepting this award, he coined the term rational exuberance. Greenspan said, how do we know when irrational exuberance is unduly escalated asset values, which then become subject to unexpected and prolonged contractions? And how do we factor that assessment in a monetary policy? That was right here in 96. And Greenspan caught a lot of flack for that because he was known to speak in vagaries, if that's a word. And not really is it the place of the Fed chair to comment on the value and the direction of future market values, as Powell tends to stay out until just recently. And he caught a lot of crap for it because, one, happened in December of 96 and the NASDAQ went ridiculously higher after that. And two, he didn't follow his own advice, because as the market was already falling is when Greenspan slashed interest rates so quickly into a falling stock market. You know what happened after the 2003 and 4 lows? Such quick low interest rates reacting to the falling tech stocks spurred the housing market. The housing market crisis, which set up the global financial crisis, which was laden with toxic mortgage debt. And I remember, like, I first started, I was a young buck in 2003 and 4 trading the market. I remember it was like WorldCom and Enron kind of were around the lows of the reaction here. But so, the thing that's kind of concerning is, did Powell just have, let me just go back, let me not transition yet. Like, this has been studied and books have written about it. I mean, this is famous. This is forever cemented his legacy, for many reasons that I mentioned. So did Powell just have his Greenspan moment? And I mean, I can't believe Trump is not losing his mind on this. I
Yeah.
can't. I I don't know. Maybe he's busy. Like, this is not like
I'm sure he'll get to him at some point, probably today.
like, it's shocking.
Yeah, not what I would have said. And I mean, if you are looking for indicators from the Fed that there's a bubble, like that, this would definitely qualify for that, I would say.
A bubble? No, but the way I look at this is this his fear of slashing rates is it will perpetuate inflation too much, maybe not in the form of equity prices, but if the market falls because of Fed commentary that he says the markets are highly valued, he's going to be forced to cut rates more than he wants, what may, just like what Greenspan did,
Right,
precipitate the housing bubble by having to cut rates too quick, too fast, too fast.
right.
So it's like, dude, if you don't want to, be forced to cut rates too much, like, why would you say that? And that was an off the
Yeah.
cuff question. Kyle, we could go back and forth, and if you have anything, jump in. But there's many different ways to look at it. There's no one way to look at, Fed policy and the way they interpret, their job. So,
Yeah.
anything on that, or?
Yeah. No, I don't see the upside in that comment. I'm trying to understand how it helps. But yeah, not what I would have said.
Yeah, right. Well, when you're when you're the Fed chair, you're gonna
They
do
should
much.
make me Fed chair.
They
I
should,
would
dude.
take that.
Oh,
I
you
could do it
crush.
on the side, right?
Absolutely. That's awesome. No, dude. Even if you're offered the chair, you're not leaving this company. You are stuck, bro. Obviously,
All right.
Kyle and I are going to be a little unhinged today on probably each of us have a combined 6 or 8 hours of sleep
Uh,
from last night.
between us, a normal
Yeah,
night. Yeah.
yeah, exactly. All right. So speaking of all that, all right. So we're looking ahead to the October meeting. So what happened was we saw GDP, we'll talk about next. Jobs number was also better than expected. The weekly claims, right? I believe. Um, Correct me if I'm wrong on that, but I know
Yeah,
GDP. Yep,
I saw that. I saw it. Let me.
I've got
I
it.
guess it was below estimate.
Yeah, the claims were the jobless claims were below estimate, so less people claimed unemployment. I've got it on the next slide. But
Yeah.
I think the point here is we were 91% yesterday of an October cut. We just did the first cut, I think, in 9 months. We're 91.9% chance of cutting in October, and now we're at 83. So, not a huge shift, but that's material. So what happened this morning was GDP, which is interesting. The third and final reading of Q2 GDP came out this morning at 3.8%, which is expected 3.3. It's a huge move. See, what happens is GDP is released in stages of three. They've got their preliminary, second reading, and then third and final for each quarter. And usually the third and final is not that big of an expectation compared to where they were previously. Well, it came in 0.5% hotter or better than expected. The pricing index, this is their GDP price deflator, came in a little hotter. Durable goods came in well above expectations. Core PCE, durable, like continuing claims was below expectation of 1930 by a little bit. So fewer people claimed unemployment. All good data. So, that's why we went from 91% chance in October of a cut to 83%. So it's not huge, but all of a sudden, like, all right, we got a pretty strong economy. The increase in this is from the BEA. Primarily reflected a decrease in imports. So a decrease in imports, tariff related, which is subtraction in the calculation of GDP, and an increase in consumer spending. So part of the reason GDP went up 0.5% above expectations is consumer spending's up. So we're like, wait a minute, do we have a stronger economy? So part of the sell-off, the beginning of the week may have been Powell's comments, but then all of a sudden we're in this dynamic that I've been in the entirety of my career, which is interesting, which is good economic data usually winds up being bad for the stock market because it encourages the Fed to be more restrictive and keep monetary policy high or strong, or don't cut rates too much to let the economy run wild, right? So it creates this inverse relationship between positive stocks and economic data. Sometimes the worse economic
Mhm.
data is, the more stimulative the Fed will be, and it's better for stock prices because stock prices look 6, 9, 12 months into the future.
Yeah.
So, yeah, anything you want to jump in on?
Yeah, I would say, in the short term that is true because of the rate dependence and bad news being good news if rates go down. But obviously, like in the longer term, a stronger consumer and a growing economy means more velocity of money, more consumption in the US, which is such a driver of the market. So, like in the short term, you get that effect, but I do think it shows up. Higher GDP, you have to believe it shows up in the future earnings of these companies that are kind of taking advantage of the growing GDP number.
Well said. Well said, sir. Um, all right. So let's just take a step back and kind of look at the technicals. Let's take a breath. And I'm watching the sell off here since Tuesday. And this is why, like, I love taking a step back and just looking at the charts, looking at the maps. Where have we been? Where are we now? Where have we been? And context and perspective matters. So this is the S&P 500 weekly chart on the left. Each one of these little bars is 1 week of trading. This is the daily. Each one is 1 day. So this is the monster sell-off that we're talking about right there. That's the last 3 days since the Powell Tuesday top. We'll see what happens. It could wind up being nothing. Um, so, I kind of just like looking at where we are, and just sometimes when you get so caught up in the short term, news headline and all the stuff that's being hit at you. I love to step back and deep breath, throw some good music on, and just look at where we are big picture, kind of regain context and perspective. And that's what charts do. It's wonderful. So I just threw some percent changes up just to give you context and perspective. Did you know from the 2009, I mean, if you bought the low, which I actually do remember trading the market. I was trading for the hedge fund back here. I remember the S&P low was 666. I remember trading it back there, which is crazy. We're up 903% from those lows. Okay. If let's say, you want to measure from this double top in 2013 from here, which is interesting how percentages work, we're up 318% from 2013 to 25. Okay. So the market's come a long, long way. Now, even from the daily chart, let's go to the lows from Q1 of 25. We're up 37% from the lows, from the breakout, which was the high early 25 and then also late 24. We're up 7%, right? So still a really, really good year. And again, this 2-3 day little sell-off is where we're talking about with this escalating volatility and the concern of a sell-off. So charts really matter to show you how far we've come longer term and how far we've really come even in 2025, which, man, we got crushed in the first quarter of 2025. I mean, it was really surprising how fast it went. And then even more surprisingly is the V shape and how fast we came back. There's a lot of momentum behind this. All right. So I think I'm going to transition here and I'm going to try to make the point to you. And I was on CNBC this morning with Dom Shu, and I've known Dom for 15 years. He's awesome. I'm going to make the point that the volatility we're seeing here is not so much as a move out of value or out of growth and into value. I think we're just going into more hard. We're going into minerals. We're going into mining in the deregulatory environment. We're going into infrastructure for AI. It's hard physical stuff that I think is in demand right now. Is we're rotating out somewhat of the GPUs and the software that powers the AI right now. It's just the kind of market we're in. So this morning I was talking about Vertiv Holdings, symbol VRT. Okay, and I'll take you through the talking points for this stock, but I just want to look at first the chart. This is a long-term chart of VRT, and real quickly, this is a physical hardware infrastructure system that literally powers the AI build out. There's coolants, there's systems management, there's power management. It literally regulates and cools GPUs that run so hot in such big clusters. So this is hardware that we'll get more into. So it's very much related to the AI trade. The technical pattern, those of you who know technicals, it's kind of a cool pattern called a head and shoulders. You get a head, left shoulder, right shoulder. Usually it's a topping pattern, but when you get it in the direction of the trend and it's an inverse one, usually it's a head up top, left and right shoulder, that signals a reversal. But when you get them and they're upside down and you break through, this is called the neckline, usually it's blast off. So I was talking to Dom this morning, and Vertiv in 2024, which is really just here, was up 200%. It's up 25% this year. And you can see what happened in 19, 20, 21, and 22, absolutely ripping. So if we can get a move through 54 to 57 in Vertiv, we could be off to the races. I'm showing you the holdings in both of our growth and in income portfolios at Inside Edge. These are the industrials, and this is the action we took. I don't mind sharing it with you. So Vertiv, VRT, we hold a 2.5% allocation, and when we rebalanced back on the 15th, we increased from 1.5% to 2%. Okay. We don't hold VRT. Oh man, I messed this up. I've got the labels backed up or mixed up. Tag goes over here, SIG goes over here. Sorry, that's 4 hours of sleep. Anyways, it says it right here. This is tag. So we hold Vertiv in tag. We do not hold it in SIG. We do hold Eaton, ETN, at a 1% allocation, which is thank you very much. That's the beauty of
Yeah,
the cloud right there, isn't it?
I love
um,
Canva.
oh, Canva's awesome. I mean, I can't wait for
Yeah,
their IPO whenever that happens.
no, seriously. Yeah.
Yeah, it's gonna be awesome. Um, So Eaton is a little bit more of a lower beta rack. It's a little bit more of a lower beta infrastructure for the AI play. So it was a good conversation with Dom this morning. We're talking about. I know you guys can't really see this. I can barely see it, but I'll read. The expectations of growth for earnings and sales. They did 8 billion in sales in 2024. They're expected to do 10.02 this year and then up to 11.5. So growth rates of 16%, 25%, 15%. But earnings went from $1.28 for all 4 quarters of 24, expected to be 327, which is 155% earnings growth year over year, combined with how flat this technical pattern is. Like, that is a leading indicator to me. And then analysts are looking for next year, which is only 3 months away, which is insane. A 35% growth up to $4.42 per share for all 4 quarters. So these are the talking points I sent into the producers this morning. So you can just read it quickly. So Vertiv, critical infrastructure service for data centers and products including power management systems, cooling, monitoring software to ensure uninterrupted power. It's also investing in renewable and battery storage, which is huge. There's a lot to do with these remote co-located power sources for these huge data centers rather than going right through the grid. They want to have remote co-located, like literally right next to it. Vertiv also did a deal with Oklo. I forgot the CEO's name, Jacob something or other, but Vertiv did a deal with Oklo, who's an SMR, small modular reactor for the nuclear plants. They're literally these small nuclear reactors. Literally, they're planting them right next to the data centers wherever they're building them. Vertiv is the company that connects the two and keeps, it filters the power from one to the other, keeps it cool, keeps it, flowing, keeps it operational, keeps the management of the connection between the two, and also keeps the GPUs cool, which, is a huge thing. So it's crazy what's happening right now. And I was just watching Brad Gerstner from Altimeter Capital. I can't wait for his new podcast that's going to come out. He's like, I'm going around and I'm watching some of these college campuses. These kids are now embracing nuclear. Nuclear is running, and it's becoming more socially accepted after all the disasters that were happening. So that's why I'm saying, like, I'm seeing a focus more on the physical infrastructure of the AI rather than just the GPUs themselves, which is NVIDIA and the software. Fundamentals of this company: they beat expectations, analyst expectations 14 of 17. They beat revenues 12 of 17. Earnings next month, which should be on the 22nd, they're looking at an 89% growth quarter over quarter the same year. They reiterated their sales forecast, net sales. They went up $500 million to $10 billion, 25% growth. $3.80 expected next year, as I mentioned. If you look at forward valuations, this is when you say, you look at your forward PE, and that is a gauge or metrics to say, is it expensive or not? If they're looking to make 380 this year, you take, your stock price, wherever Vertiv is trading, divide it at 380, it gives you a multiple of 37 times 2025 earnings. Analysts are looking collectively for $4.79. That's 29 times earnings. That is not overly expensive. When a stock's trading 40, 50, 60 times earnings, 70 times earnings, that is when things get really expensive. They are generating very good free cash flow. They got $1.4 billion in free cash flow, 14% free cash flow margin. Gross margins are consistent at 35%. So they're also part of this NVIDIA partner network. They're very able to come up with custom solutions for those implementing, big clusters of NVIDIA GPUs. They're partnered well with NVIDIA. As I mentioned, they have 3 big competitors: Eaton, Schneider, and to Vertiv. 2 big competitors, Eaton and Schneider. We hold Eaton, as I mentioned. But you just look at the growth figures. I won't go through all these stats. Your head's probably spinning at this point. The growth year over year is nowhere near Vertiv when you look at Eaton and Emerson. I mean, they're much more conservative, slower growth. They don't have that customization and specialization that Vertiv does to kind of buddy up to NVIDIA. So that's why you're seeing much more explosive growth in Vertiv. But these guys have very good positions in our dividend portfolio. Comfort Systems is another one that we've talked about before. This one is like primarily cooling and electronical management with HVAC's mechanical, but they're starting to move into data centers. We hold Comfort System in growth as well. If it really starts to make a big move into Vertiv's territory, we'll watch to see how that goes. But so far, they're a long, long ways away. So this is a fun stock that I really want to watch, and kind of along the theme that I'm saying, just looking at the physical infrastructure, the AI build out. So I'm going to echo this point again, and I'm showing you the sector allocations between our two main portfolios, SIG and Tactical Alpha Growth. So this is, every stock in here pays a dividend. We're looking for an underlying growth component. And then TAG is, no dividend required. We're looking for straight growth, competing with the NASDAQ. So I think the big thing, the theme that you'll see in here is, which is interesting, on a growth portfolio, I'm wildly bullish growth. We have a 28% allocation to technology. When you compare that to the S&P's 35%, we're actually underweight quite a bit, 6.75%. The reason is, let's say there's 100 and something technology stocks out there. I think there's probably only 10, 12, or 15 technology stocks that deserve to be in your portfolio. So though we hold a large position in the 6, 8, 10 technology stocks we hold, relative to their weighting in the S&P, there's a lot of stocks that shouldn't be in your portfolio. So we're still very bullish on growth, but the right growth stocks. We are also, relative to the S&P, we're underweight financials, staples, real estate, energy, healthcare, which makes sense in growth, but we're overweight specifically communications, which is good. But here's the kicker. We have 5.53% overweight in industrials. That's that hardware stuff in the AI build out that I'm talking about. Materials. We just saw a deal with MP Materials. The Department of Defense went in for the rare earth mineral mining, like the mining in this deregulatory environment. Trump's priority is to secure the energy source, which we were reminded during the Ukraine war that a sovereign nation's primary concern should be their energy independence and source. Trump is deregulating that, and that's going to be reflective of us being overweight materials. I have a good size in energy, and then utilities is very much on board that as well. That's straight power generation. 5 years ago, 10 years ago, if you told me in a growth portfolio you're 4.5% overweight utilities compared to the benchmark's 2.3% utilities, I'd say you're crazy. But this is a new world we live in. Go ahead, man.
Yeah, utilities and industrials are growth stocks.
It's crazy. It's crazy.
Yeah.
Like, I love looking at, but that's that's where you have to be. It's like, dude, this is a growth portfolio. We're trying to beat the NASDAQ. We're definitely trying to beat the S&P, and we're underweight tech. Like, how does that work? Well, there's other growth areas in this market that make this AI trade work. It's so cool how it works.
Yeah, and it's where we're at in the growth cycle. I mean, tech was outperforming there. I mean, since the 22 bear market, it was outperforming pretty much the whole time until probably the beginning of this year, I would say. So it's just done so well that now we're looking at, okay, what are the materials, what are the industrials, what are the utilities that actually make those tech companies work? And that's kind of the theme of the market right now.
Could I just ask you, if you're listening at home, is your money manager just putting you in S&P 500 benchmark and charging you 1%? I'm sorry, I don't mean to laugh. That was rude. Was it? Was that rude, Kyle?
No, just being real.
All right. Back on track. Okay. So let's just look at the rotations. And I know a lot of you are like, I don't even know what the heck this means. Like, I look at charts that move along the time axis and the price axis. These guys work on a rotation, kind of like a clock. Let me see if I can. Oh, here we go. You know what? We'll play with it a little bit. Let's play with it. Okay. So, you know what? Forget it. Let's play with them. I want to show you how they work. This is the actual rotations. Let me see if I can squeeze this up. Okay. So, what we're looking at here is Dow Jones value in blue and Dow Jones growth in the yellow here. If you're on the right side, you're outperforming. If you're on the left side, you're underperforming. And what you can do is you can kind of follow the time here. And as you know, you get a switch from left to right. So it pretty much happened in September of last year. Growth went to the right and value went to the left. Now, the whole thing is value going to rotate back in? Growth rotates out? That's a clear sign that we need to change our aggressiveness in this AI build out. And okay, here's growth. This is going to be in March of this year. We're starting to head back down. We're leaving the leading quadrant, heading the weakening, threatening to move on the left. And if growth goes left, value trade is going to go right. But what we're getting is we're getting a little hook back up on the monthly. Okay. So each, this every time it changes 30 days, 30 calendar days passes. So it's a lot of time in between updates. From the monthly, we can get down to the weekly. This is going to be much more sensitive. So what happened? We saw a big move in June up until there's July, August, September. We've seen a really good move in the NASDAQ. Okay. Just this little sell-off in the last 3 days is this little hook down, okay? Growth is still in control. Value is still well out of control. We're just starting to get these little hooks. The reversal here on the weekly, if it continues to manifest, it's going to take 6, 8, 10, 12 weeks of growth going this way, value going this way to say relative momentum and relative trend have shifted in favor of growth, and we need to get more protective in the portfolios. That there needs to be 6, 8, 10 weeks of updates in that direction before we're really going to see the potential hook back in favor of growth fail and head in that direction. So it's just a quantitative way to look at the market's preference for growth or value, and it's a great way to know, what's what area of the market is in control. All right. I was going to go in a kind of a crazy different direction and talk about some of the industrials, some of the electronics, and just kind of have fun to show you how we go through the stock selection process and just to show you how diverse the group of leaders are in this AI build out, which is kind of the theme of today. But before I do that, I'm going to come back to it. I'm going to keep pushing through. Kyle's going to work some tax equivalent stuff. Those of you who are interested in the real guts of the market, I'm going to pull out my trading software and I'll show you how we kind of scan through. I'm going to show you some of these fun electronic companies that we're looking at and just do a little exercise there. But I'm going to push through. We're going to go over to planning a little bit and then I'll come back to this.
Yeah, so wanted to put together a couple slides on municipal bonds. I've had it come up with clients, I'd say several times in the past week or two, and so figured it'd be a good time to review it with everyone. So municipal bonds, probably a lot of you know or are familiar with these. They're U.S., local, and state created bonds. The interest on these bonds is exempt from federal taxes, and if you are living in the state where the where the bond is purchased and they have state tax, it can be exempt from that too. And so, looking at where rates are right now, if you are in the top bracket, it mathematically does make sense potentially to consider municipals over a taxable bond. Keep in mind there are different risks for a state and local bond. Mostly the big difference is default risk if you were to buy individual municipal bond in a specific town or state. But you can buy ETFs and group those together. And then that would, be a collection of these local bonds and kind of mitigate that default risk. The formula you see here, this is how we compare a taxable bond to a tax-free bond. It's a pretty simple formula. So, if you're on your own looking at taxable bonds versus a tax-free bond, this would be a very quick way to compare the interest that each bond is paying.
Got it. Good.
And on the next slide, next slide, I wanted to put together an exercise where, how we would look at different options. So you can see a nice old paper bond note there in the top right before everything went electronic. But yeah, this is going to be kind of our exercise. If we're talking with a client and they are considering where to place some money, whether it's part of their allocation that we do want to have some fixed income, or if it's someone who just needs a placeholder for short-term cash needs. This is the type of information that we would put in front of a client to kind of decide what the best option for them might be.
Do
So bullet point
I've
three
got to
here.
interrupt. I'm sorry.
Yeah, yeah,
1976 at 8%. That's just
I know.
awesome.
That
That's
was,
so awesome.
imagine buying a 30-year bond in like the late 70s. What a smart decision that would have been.
All right, sorry to interrupt. Please continue.
Yeah, no, my mom would be so proud of me if I had done that, but I wasn't born yet, so it's okay. But yeah, the third point bullet here, this would be a U.S. short-term municipal bond fund, like an ETF that I had mentioned. Um, and in this example, it pays a 2.99% tax-free yield. And then if you take that formula from the previous slide and apply a 37% tax rate, that's the top tax rate under the new law, the tax equivalent yield would be
Wow.
4.75%. So the muni ETF would be worth as much as a taxable bond paying 4.75, assuming everything else was the same in terms of, their term to maturity and everything else.
I'd love to see a sort of a schedule on the various tax brackets to see like the delta and the tax equivalent yield as you go down.
Yep. Yeah, Schwab, which we use, has a pretty good table to show that, so
Yep.
that speeds up our process. And that's something like with clients, we'll usually just take a screenshot of that and show people where the different yields are for the different maturity dates, as well as the different types of bonds, whether they're municipal, US, or corporate.
Gotcha.
So 4.75 equivalent on the short-term muni. The next option could be a state-specific municipal bond fund. This would be exempt from both state and federal tax. You do usually need to buy this in your state of residence. So if you're in California, you'd buy a California bond. If you're in New York, you'd buy a New York bond. But in this example, if you apply the 37%, and then Todd, you probably know what state tax rate that is.
That 10.9 is New York, baby. We're not 12, I think. Isn't California 12? Maybe even 13. What's that?
So I said it would need to be higher, right? Being
Yep.
California, but
Yep.
I think it is 12. Yeah. So put that together on a similar yield as the US, where you would still be paying a state tax. This one, the example was 2.9. So once you put state and federal, that tax equivalent is 5.68%,
Hmm.
which would be hard to get right now on a taxable bond, unless you started looking for lower quality bonds.
Sub investment grade junk crap.
Exactly. But
Yep.
these would all be close, I would say close to what a high quality bond fund or individual bond is yielding here in the last week when I pulled these numbers. So 5.68 on the state specific, if that's works with what the client's trying to achieve, then that would be a better option than the U.S. short term. Say the person in question wants to lock in their yield. As we've covered, rates are going down right now. So on the short-term municipal bond fund, while the price of the fund doesn't change, when rates go down, then a short-term fund would start paying a lower interest every month that rates go down. So the individual bond would be locking in your yield to maturity by buying an individual bond. You would pick which municipality or state that you bought the bond from, and then hold it until maturity in order to lock in your yield. So if you want to make sure you're not seeing your payout go down as rates go down, then this might be an option for you. There would be different risks, like I'd mentioned, the default risk of that individual municipality. We have had municipalities default in the past. It was happening a lot in the 2010s. We were seeing it. So, anytime you did take a individual bond on, you'd want to check on the area, check on what you're actually getting, and make sure it's an investment you want to do. But assuming the 37% and 10.9% tax rate on a 2.426 current yield, let's say, the tax equivalent yield would be 4.748. So that would be something, if you wanted to lock in, maybe you have a tax bill due in April, or a wedding coming up, or some large expense or cash need, short term kind of need to place money, and it's a very predictable date that you'd be withdrawing that money, then you might go for a individual bond.
Nice.
And then just to benchmark it against everything, or the three we've covered are municipals. What you want to do when you look at municipals is benchmark it back to the short-term taxable yield at that point. So this would be the example. Taxable yield at 4.32% is what I saw in the fund that I looked at. So that would be fully taxable, state and federal. And that's, basically the equivalent of these tax-free adjustments that we did on the other three. So if you're looking purely at yield, tax adjusted yield, and that was all you cared about, you've been following along, it'd be the state specific municipal bond fund in this case.
Very nice. Very nice. Well done. Well done. Yeah. It's a pretty hard right turn as we go from, the active management in the stock market into tax equivalent yield in munis. But,
Yeah.
this is the beauty of active management. This is the beauty of working with somebody who, a company organization where we can earmark out your different buckets of money and ensure that you're seeing, the purposes and the vision for each bucket of money, seeing it through to completion with different risk metrics. And, it's so incredibly important, especially as I'm talking to the active management community out here, because a lot of the people who know me, us from the trading world. And I think for traders who, are so engrossed in the market, they tend to set aside and forget about, the longer term planning and understanding what each bucket and account of money stands for within your overall plan. It's you guys, you active traders, it's even more important that you have a financial plan. So any,
Absolutely. Yeah.
yep. I'd say that better. I'm
Yeah.
4 hours of sleep and
It's,
a head
I
cold.
mean,
Say that better than me, please.
it's key to find the right allocation that works the best for you. If you think about it between stocks, growth, and then fixed income, or kind of defensive on the other side, like an imbalance in one hurts you on the other. I mean, if you go through a process, you
Well
understand
said.
how you're invested, and you know what to expect, then that's what helps people stick to a plan. And the reason that's important is because, like the execution, it's tough to execute on a plan if you feel like you haven't fully thought it through. And
That's the
then, I
truth,
mean,
man,
once you
right
get
there.
into, yeah,
To
and then
not only
beyond
thought it
that,
through, but have someone keep you accountable to it and create a little bit of
yeah,
arm's length. Yep.
exactly. Yeah, and so that's a huge part. And then we're also going and looking at, not all money market or bond funds are created equal. What's the best for what's like now we've made a plan. Now let's execute it in the best way possible. So that's that's like that's the whole process right there. I mean,
Well done.
know what you're doing and then execute well.
Well done. All right. Really good there. All right. So that's going to cap the top for the most of the presentation. I got a few minutes. I got a 1 o'clock call actually with CNBC. I got to jump in. I do want to go through the software just a little bit and kind of show you some fun stuff if I can. It's going to be a little technical from here on out. And this software does not like scrunching up on a 1080p small monitor, so anything can happen. This is not officially part of the presentation anymore. But before I jump into that, Kyle, anything else on closing thoughts?
Not so much. We'll for clients, we'll go into our rebalance. We were planning to cover rebalances, but we'll go do a deep dive into those next week. So
Yep.
look forward to
Yes.
that.
Yeah. And I think it was more right. We were going to go into the rebalance. We did talk about, a few of the industrials in our weightings. I'm more focused on the market volatility this week because it is kicked up again. We're making jokes about August, how quiet it was. I think it's more important to talk about the state of the market and the key events that happened this week. And, we go into a rebalance. We got more aggressive on TAG, which is the growth model. We got less aggressive on SIG with that 10% allocation to a covered call, JP Morgan fund. So we're kind of straddling the fence, but we're saying to all of our investors, like, yeah, we got more aggressive on growth, but it doesn't mean we have to stay that way. If the facts change and the thesis change, we're going to get on it. And the point of today is to say there's just a different flavor of the growth trade, I think, rotating in. It's not an outright rotation out of growth into value, into safety. It's a different flavor, I think, is the main point that I have, at least for today. And we can deal with, in talking about all the changes made to the portfolios. That's a long ongoing conversation that we'll have looking at different parts of it. But Vertiv, I think, is a really important part of it, talking about the industrials. So,
Sounds reasonable to me.
yes, sir. All right. So this is kind of a fun exercise that I do when I go through looking for companies and looking for sectors and industries and industry groups. So ones that we can trade and look at the internals. Very much on the same path. You're going to see me hit the refresh button a few times. Deep View is a software I use. It gets a little buggy. It's a real heavy software. And again, it's on a monitor size that it doesn't like. But what I'm doing here is I'm searching for all stocks above $1 billion market cap that are within this group of stocks. Now, I want to introduce you to something we've talked about, and I want all investors of ours to understand this. Like, we talk about sectors. There's 11 sectors that make up the S&P: communications, consumer discretionary, staples, energy, so on and so forth. Within each sector, that has groups of stocks like banks and let's see, brokerages. What do we have? We have banks. This is the next lower. Insurance would be another within financials. This is, each sector has a group of groups, right? That's the next lower level in the hierarchy. Okay. Now, within each sector and group, we break it further down into industries. Obviously, banks is going to be an industry within the banks group, within the financial sector. This is a way just to characterize your stocks: consumer finance, et cetera, et cetera. And then they go even further down into sub-industries. This classification of sectors is called GICS, which is the global something classification system. I forgot what the I is, whatever. But it's S&P Global, SP, you know the company. It's their classification, proprietary classification system that's widely used. So we're looking at, the sectors that make up the S&P, the groups, industry and sub-industry group. Now, along that same line of this rotation that we're seeing into hard stuff, into the architecture, into the minerals, rare earth, the stuff that makes up the AI trade. I wanted to look at everything that was included within the sub-industry groups: electric utilities, electrical components and equipment, electrical components, electronic equipment and instruments, electronic manufacturing services, and heavy electrical equipment. You're like, what the heck is the difference between all these? And I don't know what group of analysts decides what company goes in which group. I also put renewable electricity in there. So, and technology, hardware, storage, and peripherals, which, fun fact, Apple is part of this group. But I just wanted to look at that group. Okay. So all of those stocks within that sub-industry group that have market capitalizations above $1 billion, there's 143 stocks. Okay. So from here, what I did is I sorted. This is a fun little thing you can do on the software. I'm going to clear the sorting. You can do multi-level sorts. So here's the sub-industries that I mentioned right here. If I click on sub-industry, it's going to sort all the stocks within electric utilities, components, et cetera, et cetera. So then what I wanted to do is I put in year-to-date change. Okay, so my second level sort will be year-to-date change. So let's find the stock that's up the most within electric utilities, which is 457% returned year-to-date, which is Oklo, which is the company that I talked about that did a deal with Vertiv, right? So then we can go over and look at, the stock IPO'd at what? $15, traded down to $6, and now we're at 118. Okay, so part of the thing that I like doing is organizing stocks as I go through the research process based on, this among many other processes I do, and then start to look inside the company. So Oklo, it's a utility, electric utility, market cap 19.36 billion, no yield. Next earnings are going to be November 11th. PE ratio is out of control. Doesn't really have earnings. Beta, the S&P's beta is 1. This is 2.68, extremely more volatile than the S&P. It goes into some proprietary rankings in terms of the fundamental rank, so on and so forth. But the point that I wanted to make is, if you look at this right here, and this is one of the most important things that I do when I look at a company, is click on this, which is the company's website. And if I click it over here, you go in and read some of these websites. That website's awesome, by the way.
Yeah, it is.
And that's, Kyle, this is such a subjective, and I got to 1 o'clock. Oh my God, I'm going to be late. I got to jump. This is such a subjective thing, but if you go and just look at the websites and read, some of the descriptions of these leaders within these electrical AI build out names, it's unbelievable the stuff you will see and read and find out about the company and the impact that these companies are having. It's crazy. It's just a fun little exercise, and I'm way out of time. I got to get moving here. But here, let's go to D-Wave Quantum, up 211%. Different classes up 588%. D-Wave Quantum. You want to see the future, go click on dwavesys.com. It's crazy what the future holds. So one of the best things to do when you're looking at a company to invest in is go through the technical process I went through, but then go read the website. Kyle, I have to get out of here. I do not want to be late.
Yeah, no worries. Good talk, and look forward to continuing it next week.
Excellent. Thanks all. I hope that was helpful. Have a great rest of the week, and we'll catch you all next week. Clients, if you have any questions, comments, you know how to get a hold of us. Let us know we're here. All right. See you guys.